Precious metals bull markets, and we're in one, by the way. Let's not equivocate about that anymore. When the momentum is established by gold, and that momentum attracts generalist investors to the precious metals market, when those people come down into the precious metals market, market leadership changes from gold to silver. Why? I don't know. Maybe because of the lower unit price. But what I do know is that you won't need Rick Rule to tell you when you're in a silver market. And a short position in a market with the upside volatility that silver has relative to almost any other commodity on the face of the earth, I believe has the ability to deliver truly a religious experience.
Gold is performing strongly, recently hitting all-time highs fueled by escalating U.S. tariffs and rising recession fears. In contrast, silver dipped to 8-week lows earlier this month due to concerns over industrial demand, but has since rebounded, now trading above $32. According to the World Silver Survey 2025 by the Silver Institute, global silver demand fell by 3% in 2024 to 1.16 billion ounces. The gold-silver ratio, currently around 100, highlights silver's relative undervaluation. Silver is eyeing price targets of $34 and $35 as this ratio peaks, driven by renewed interest. This raises the question, does silver's 50% industrial exposure and recession risk justify its current discount? Rick Rule, CEO of RuleInvestmentMedia.com, states that gold and silver are in a confirmed bull market, with gold currently leading amid rising inflation and debt concerns. Based on past cycles, he notes that once gold gains momentum, silver often takes over as the outperformer. He advises holding silver as it preserves wealth and may outperform during monetary instability. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
I think what will happen is that silver will maintain its purchasing power. So in addition to having silver, one must have a lifestyle that one can live within. In the decade of the 70s, Duncan, as you will notice, I was there, purchasing power of the U.S. dollar deteriorated by 75%, which is to say that $1,000 in 1980 bought you $250 worth of goods and services at 1970s pricing. What precious metals really did, although they overshot, was they maintained your purchasing power. So for the gentleman, store some of your wealth in silver, which is highly likely to maintain and perhaps outshoot in terms of purchasing power. But also consider aspiring to a lifestyle that's well within your ability to sustain. Both parts are important. Precious metals are notoriously volatile, and silver is more volatile than the rest. I'm reminded of the decade of the 1970s, where in the beginning of the decade, gold was up from $35 an ounce to $200 an ounce. In early 1975, the Fed, concerned about inflation, raised the interest rate, which cratered the gold price. It fell from $200 an ounce to $100 an ounce in 9 short months. Of course, the Fed lost its nerve because it cratered the bond market and the stock market too. When the Fed reversed course, the gold price ran from $100 an ounce to $850 an ounce. What's important to remember is that if the underlying conditions favoring a bull market stay intact, the bull market will stay intact too, but it will certainly test your patience, your faith, and your bank account in the interim. And I think probably we're due in the near term for a rest in terms of the gold price. It's also worthy to note that silver has not, as of yet, kept up with gold's pace. The Wall Street guys do what's easy. And for 40 years, beginning in 1982, the U.S. dollar was ascendant and precious metals were descendant. Silver being more volatile than gold, it was an easier thing to short. The second thing is that the silver market is extraordinarily leveraged. Many days, 100 or 200 times the amount of silver available for good delivery trades hands in the futures market. What that means is that it's remarkably easy to short. These masters of the universe create short ladders, going out 3 months, 6 months, 9 months, 12 months, 18 months, borrow a fair amount of physical silver, sell that silver in the overnight market when the liquidity is the least, so that they can have the biggest impact on the silver market, and then look for the price signal from the physical market to impact the futures market. If somebody is short, let's say $1 billion worth of silver in the futures market, and somebody uses $50 or $75 million worth of silver, they lose, say, $10 million on selling into the physical market. In effect, you're investing $10 million in your loss in the physical trade to make $50 or $60 million in the long-term trade. I have now been through 3 real bull markets in precious metals in my life. And I don't know why it's true, but what I do know that is true is that in precious metals bull markets, and we're in one, by the way, let's not equivocate about that anymore, when the momentum is established by gold, and that momentum attracts generalist investors to the precious metals market. When those people come down into the precious metals market, market leadership changes from gold to silver. Why? I don't know. Maybe because of the lower unit price. But what I do know is that you won't need Rick Rule to tell you when you're in a silver market. And a short position in a market with the upside volatility that silver has relative to almost any other commodity on the face of the earth, I believe has the ability to deliver truly a religious experience to the short side, irrespective of the structure of the market. These short guys do whatever's easy. I remember in the decade of the 70s, there was a lot of manipulation in precious metals markets to the upside, because that was the bias in the market. Wall Street learns thoroughly, but they learn slowly. They do now what made them money for 40 straight years, and they will do it until, like 2008. I think gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. So I'm going to keep a substantial position in gold until a few things happen. The federal budget is balanced. We have a fiscal regime in place, but I don't have any artificial peg in place that says when gold goes to 3,500, I'm going to sell. Or if the gold price falls from 3,500 to 3,200, I'm going to sell. Remember that we measure gold in a floating abstraction called the US dollar. When other forms of savings appear to me more attractive than gold, believe me, I will sell gold and buy those. But measured clearly in a US dollar circumstance, as I say, I'm buying gold to shield my purchasing power from the declining purchasing power available to me in conventional savings products. And until they see those threats disappear, I'll continue to hold my gold.
In the short to medium term, mounting global economic tensions and the threat of stagflation, defined by sluggish growth, rising inflation, and weakening employment, are creating a supportive environment for gold. And to a lesser extent, silver remains undervalued following its April dip. Expectations of over 75 basis points in Fed rate cuts by year-end, combined with strong demand from central banks and wealthy investors, especially in Asia, looking to reduce their reliance on U.S. bonds and the dollar, are further fueling this bullish trend. While some view gold as the ultimate haven, others are drawn to silver's potential upside. What about you? Do you lean toward gold's stability or silver's potential? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.